Picture this: July 1944. The global financial elite has convened in Bretton Woods, New Hampshire, celebrating what they believe is the dawn of an unprecedented era of economic prosperity. Delegates are congratulating each other, convinced they've engineered the perfect monetary framework to usher in an age of stability and growth for the post-war world. Yet amidst this jubilant atmosphere, a French economist named Jacques Rueff perceives something entirely different within the intricate mathematical architecture they've just erected. While others revel, Rueff is already identifying what he deems a fatal flaw, deeply embedded in the very bedrock of the system. The calculations Rueff made that summer would prove remarkably prescient for the subsequent 27 years. His warnings about the system's inherent instability were dismissed, ignored, and ridiculed, only to be vindicated with striking mathematical accuracy on the very day they were foreseen. This is what should capture your attention. America received a profound warning 80 years before the current monetary crisis. The same fundamental issues Rueff pinpointed in 1944 are screaming at us today, yet we continue to turn a deaf ear. The system our leaders lauded so enthusiastically harbored a critical vulnerability from its inception. Under the Bretton Woods Agreement, America would supply the world with dollars, serving as the primary reserve currency, pegged to gold at $35 per ounce. It sounds reasonable, doesn't it? However, Rueff immediately recognized the mathematical impossibility. For the global economy to possess sufficient dollars for international trade, the United States would need to run balance of payments deficits. This meant spending more abroad than was earned, thereby injecting dollars into the global economy. But here lay the problem that sent a chill down Rueff's spine. Such deficits would inevitably outstrip America's gold reserves. At some point, foreign nations would hold more dollar claims than America had gold to back them. Consider this scenario. You promise to exchange your IOUs for gold whenever anyone demands it. However, to provide enough IOUs for widespread use, you must issue more than the actual gold you possess in your vault. What transpires when everyone arrives simultaneously, demanding their gold? Rueff calculated that this reckoning was not a remote possibility. It was a mathematical certainty. The system was designed to self-destruct. Yet in 1944, America was basking in the glow of victory and economic dominance. Our officials brushed Rueff aside as just another European gold bug clinging to outdated notions. Treasury Secretary Henry Morgenthau even scoffed when presented with Rueff's concerns, remarking to his staff that the French were still thinking in 19th century terms. This was not mere ignorance, it was a willful blindness fueled by American exceptionalism. Our leaders genuinely believed that America's economic might rendered the laws of mathematics irrelevant. We were so dominant, they reasoned, that foreign countries would continue accumulating dollars indefinitely, never demanding the gold we had promised them. By the early 1950s, Rueff's warnings were already proving accurate. The American balance of payments deficit was expanding precisely as he had predicted. Our gold reserves, which had peaked at over 20,000 tons in 1949, began a steady decline. According to Federal Reserve data, we were losing gold at the exact rate projected by Rueff's calculations. What makes this narrative truly exasperating, however, is America's persistent disregard for these warnings. When Robert Triffin formalized Rueff's insights in 1960 in what became known as Triffin's dilemma, mathematically demonstrating the system's unsustainability, American officials still dismissed it, labeling it as theoretical economics, detached from real-world practicality. Meanwhile, Rueff continued to publish his findings, refining his temporal predictions with each passing year. He was not an alarmist, making vague pronouncements of doom. He was presenting concrete mathematical evidence outlining precisely when and how the system would unravel. The most chilling aspect is that Rueff had foreseen that when the crisis finally arrived, America would not admit the system's fundamental flaws. Instead, we would frame it as a temporary emergency requiring temporary measures, promising a return to convertibility once conditions improved, all the while knowing such a return would never materialize. This was more than a matter of monetary policy. It was about America's relationship with mathematical reality. Rueff had provided us with a precise map of our financial future, complete with warning signs and escape routes. But our leaders so intoxicated by the privileges of monetary dominance, chose to ignore the countdown he had initiated in 1944. Every ounce of gold that departed Fort Knox was another tick of the doomsday clock. Every increase in our balance of payments deficit represented another step closer to the inevitable reckoning. The red flags were all there, flashing for anyone willing to see, but America had made its choice. We would ride this tiger until it threw us off. Consequences be damned. What unfolded next reveals everything one needs to know about how America handles uncomfortable mathematical truths. Instead of heeding Roof's warnings, our government launched a systematic campaign to discredit anyone who dared question the dollar's supremacy. Between 1958 and 1961, Jacques Rueff published a series of detailed economic papers that read like a countdown to financial catastrophe. He wasn't making vague predictions of future problems. He was providing specific mathematical models illustrating precisely how and when the Bretton Woods system would collapse. His calculations indicated that the breaking point would occur when foreign dollar holdings exceeded American gold reserves to such a degree that confidence would irrevocably crumble. Data from the Bank for International Settlements from this period show Roof's predictions unfolding with unsettling accuracy. United States gold reserves dwindled from 20,312 tons in 1957 to 17,804 tons in 1960, while foreign dollar claims surpassed $18 billion. The numbers were playing out exactly as Roof had foreseen. Yet instead of taking these warnings seriously, American officials devised a standard strategy of dismissal. Any criticism of the dollar system was immediately labeled as European jealousy or an obsolete gold standard mentality. Treasury officials informed the press that these foreign economists simply couldn't grasp the new sophisticated realities of modern international finance. Then, Charles de Gaulle decided to transform Roof's academic warnings into official French policy. In February of 1965, de Gaulle held a press conference that sent shockwaves through Washington. Addressing the cameras directly, he declared that France would no longer accept what he termed the exorbitant privilege of American monetary dominance. He called for a return to the gold standard, citing the very same mathematical arguments Roof had been advancing for over a decade. Consider the audacity of that moment. The leader of our oldest ally publicly denounced the American monetary system as fundamentally unfair and mathematically unsustainable. De Gaulle wasn't just criticizing policy, he was referencing Jacques Rueff's specific predictions about when and how the system would collapse. America's response was a flat-out rejection. The Johnson administration immediately characterized de Gaulle's statements as the envious pronouncements of a declining empire seeking relevance. Secretary of State Dean Rusk told reporters that France was living in the past and didn't understand the benefits of dollar-based stability. But here's what makes this story so infuriating. While American officials publicly dismissed these warnings, privately they watched them unfold with mathematical precision. Minutes from Federal Reserve meetings of that era, released decades later, reveal central bank officials expressing grave concerns about the very issues Rueff had identified. France wasn't just talking, they acted on Rueff's warnings. Between 1963 and 1966, through Operation Vitus, France systematically converted dollar reserves into gold, repatriating 3,313 tons from American vaults. Other countries began to follow suit. According to Treasury Department data, foreign gold redemptions surged from $1.7 billion in 1964 to $3.2 billion in 1965, and then to $1.967 billion in 1966. Even our closest allies began sounding the alarm. British Prime Minister Harold Macmillan privately suggested to President Kennedy that America should devalue the dollar to $70 per ounce of gold to mathematically rebalance the system. Kennedy categorically rejected the idea, arguing that America's economic strength rendered such measures unnecessary. The pattern was becoming clear. Each warning proved more accurate than the last. Yet, America's response remained consistent: deny, dismiss, and double down on the failing system. By 1968, the mathematical reality calculated by Roof in 1944 was becoming undeniable. The London Gold Pool, established to cap gold prices and maintain confidence in dollar convertibility, was bleeding gold at an unsustainable rate. In March of 1968, the pool collapsed after losing 1,000 tons of gold in just 3 months. According to Bank of England data, the final week saw panic-driven purchases, draining reserves faster than anyone thought possible. This was the moment Roof's temporal predictions materialized into an immediate crisis. Foreign governments were no longer quietly exchanging dollars for gold. They were stampeding for the exits before the inevitable collapse. Switzerland, Belgium, and the Netherlands joined France in systematically accumulating gold, creating precisely the crisis of confidence that Roof had mathematically proven to be inevitable. Yet even as the London gold pool cratered and gold markets plunged into crisis, American officials continued to publicly insist these were merely temporary disruptions in an otherwise sound system. Treasury Secretary Henry Fowler announced that the dollar's fundamentals remained strong and convertibility was never in doubt. But meeting minutes tell a different story. In closed-door sessions, the very officials who had publicly dismissed Roof's warnings were privately discussing emergency measures to stem gold outflows. They knew the math was impossible. They simply couldn't admit it publicly without triggering the very crisis of confidence they were trying to prevent. The tragic irony is that by 1969, even American economists were arriving at the same conclusions Roof had published back in 1944. The work of Robert Triffin at Yale was demonstrating that the system contained intrinsic contradictions that made collapse mathematically certain. Yet instead of crediting the French economists who had identified these issues 25 years earlier, American academic and political circles treated these insights as novel discoveries. By 1970, the warnings that had been dismissed for over a decade as European jealousy were becoming the consensus view among international monetary experts. The system was hurtling toward the breaking point Roof had calculated with astonishing precision. Foreign dollar holdings had surpassed United States gold reserves by a ratio that made maintaining convertibility impossible. America had spent 30 years attempting to silence every doomsayer, but mathematics doesn't care about public relations campaigns. The countdown that began in 1944 was nearing zero, and no amount of denial or refusal could stop what was about to happen. Camp David, Maryland, August 13, 1971. President Nixon sits with his economic advisors, staring at numbers that would have brought a wry smile of satisfaction to Jacques Rueff. After 27 years of ignoring warnings about mathematical impossibility, America was finally confronting the exact scenario the French economist had predicted with chilling accuracy. The figures on the table told the story of a system in terminal decline. United States gold reserves had fallen to just over 10,000 tons. As foreign claims on American gold exceeded $40 billion at the official rate of $35 per ounce, America owed foreigners more gold than existed in Fort Knox, the Federal Reserve, and all other U.S. repositories combined. This was not a temporary liquidity crisis or a confidence problem that better communication could solve. This was the mathematical outcome Roof had calculated in 1944, playing out precisely as he had foretold. The system required America to supply dollars to the world through balance of payments deficits, but those very deficits had ultimately surpassed the limit for honoring our gold conversion promises. Paul Volcker, then Undersecretary of the Treasury, would later admit what everyone in that room knew but couldn't say publicly. The French had been right about the math. The very warnings that American officials had dismissed for 3 decades as European jealousy now proved to be a precise mathematical prophecy. What makes this moment particularly striking is its exact alignment with Roof's specific predictions. He hadn't just warned that the system would eventually encounter trouble. He had calculated that the crisis would erupt when foreign dollar holdings reached a critical mass, making gold convertibility obviously impossible. In August of 1971, that critical mass had been reached and surpassed. Treasury Secretary John Connally laid bare the stark truth for Nixon. We may never get back to it. Convertibility. I suspect we never will. This was not a temporary emergency measure they were contemplating. It was the definitive abandonment of America's promises made at Bretton Woods. The system declared mathematically doomed in 1944 was finally admitting defeat. But here's where the story becomes truly infuriating. As Nixon prepared to showcase the validity of Rouffe's warnings, his administration was planning to frame the collapse precisely as the French economist had predicted. Instead of admitting the system's fundamental flaws, they would claim it was a temporary response to currency speculation and promise to restore convertibility once conditions improved. On the evening of August 15, 1971, Nixon addressed the nation with a speech that could have been written from Rouffe's predictions. He announced the temporary suspension of dollar convertibility to gold, blamed foreign speculators for imposing this emergency measure, and pledged that America would work to restore stability to international monetary relations. Every element of this presentation mirrored exactly what Rouffe had foreseen American leaders would do when the inevitable crisis struck. They would assert the system was fundamentally sound, yet temporarily compromised by external forces. They would promise to reinstate the old arrangements once conditions improved, and they would never admit that the math had been impossible from the start. The international reaction proved how accurate Rouffe's warnings were. European finance ministers expressed their dismay not at the suspension itself, many had anticipated it for years, but at the precision with which it aligned with timing and circumstances foreseen by French economists as far back as the 1950s. According to records from the Bank for International Settlements, the days following Nixon's announcement saw precisely the kind of global monetary chaos Rouffe had warned of. Without the anchor of gold convertibility, currency exchange rates began to fluctuate wildly. The stable system Bretton Woods was meant to create dissolved overnight into the floating rate uncertainty Rouffe had defined as inevitable. British Chancellor of the Exchequer, Anthony Barber, summarized the European perspective. "For years, the Americans told us our concerns about the dollar were unfounded. Now they have proven our concerns were entirely justified." The very allies whose warnings had been dismissed as jealousy had suddenly revealed themselves as the realists in the room. What is particularly striking is how private communications from the Nixon administration, released years later through Freedom of Information Act requests, show officials acknowledging they were implementing precisely the scenario Rouffe had outlined. They knew they were validating the French economist, but political considerations made public admission impossible. The bitter irony extends beyond the suspension itself. In the months following August 15th, as Nixon's team sought to negotiate new international monetary arrangements, they found themselves grappling with all the problems Rouffe had identified: fluctuating exchange rates and fiat currencies. Without the discipline of gold convertibility, inflation began to accelerate, trade imbalances widened, and currency instability became a permanent feature of the international economy. By December of 1971, as the Smithsonian Agreement attempted to restore some semblance of stability with new fixed exchange rates, it was already clear these measures were merely temporary patches on a fundamentally transformed system. The gold standard that had underpinned international monetary relations for centuries was gone, replaced by precisely the kind of discretionary monetary system Rouffe argued would lead to chronic instability and inflation. Perhaps most remarkably, Jacques Rueff himself, now in his 70s, lived long enough to see his 1944 predictions confirmed with mathematical precision. The system had collapsed precisely as calculated, almost to the minute predicted, through the very mechanism identified as unavoidable. For 27 years, America had dismissed the warning, attributing it to European envy and outdated thinking, yet mathematics remains indifferent to politics or national pride. The countdown initiated by Jacques Rueff in 1944 had finally reached zero, and its repercussions would reshape the global economy for the ensuing 50 years. The most chilling aspect was our impending repetition of the exact same errors. This is what should truly alarm every American. We are reliving Jacques Rueff's warning, and our leaders are responding with the identical pattern of denial and dismissal that spectacularly failed in 1971. The mathematics that dismantled Bretton Woods has not vanished. It has merely transformed. Instead of pledging to exchange dollars for gold, America now promises to honor dollars, underpinned solely by faith in our government's ability to manage an unmanageable debt. We have traded one mathematical impossibility for another, and the countdown is once again underway. Consider this scenario. America currently oversees more than 750 military installations worldwide, projects power across every continent, and maintains the world's reserve currency, all financed by the same mechanism Roof identified as unsustainable 80 years ago. We inject global liquidity through enormous deficits, creating more dollars than our economy can realistically sustain through productive activity. Our national debt has ballooned to exceed $33 trillion, a figure so immense it represents over 120% of our entire annual economic output. Projections from the Congressional Budget Office indicate we add over $1 trillion to this debt annually, with no mathematical possibility of conventional repayment. This is Jacques Rueff's nightmare in modern form, perpetual money creation sustained only by promises we cannot keep. The parallels to the 1960s are striking and terrifying. Just as foreign nations began questioning the dollar's convertibility when our gold reserves proved insufficient to back our overseas commitments, today's rising powers are questioning whether American debt levels can support the dollar's global role. China, Russia, India, and Brazil, collectively known as the BRICS nations, are systematically reducing their dollar holdings and establishing alternative payment systems. What makes this situation even more exasperating is that American officials are responding with the same dismissive rhetoric that failed in 1971. When China announces new gold purchases or bilateral trade deals bypassing the dollar, our Treasury labels it economic nationalism that disregards the benefits of dollar-based stability. When Russia and Iran develop payment systems outside the SWIFT network, we dismiss them as authoritarian attempts to undermine the international order. Does this sound familiar? It's the same playbook used against Jacques Rueff and Charles de Gaulle. Dismiss critics as envious rivals who fail to grasp the sophisticated realities of modern finance. Yet the mathematics remain as unforgiving today as they were in 1944. According to Federal Reserve data, our money supply has surged by over 400% since 2000, while our actual productive capacity has grown by a mere 50%. We are creating dollars far faster than we are generating genuine wealth, precisely the type of monetary expansion Roof predicted would ultimately destroy confidence in any monetary system. Everywhere we look, warning signs are flashing red. Gold prices have soared from $300 an ounce in 2000 to over $2,000 today, suggesting markets are pricing in the very currency devaluation climax foretold by the abandonment of gold backing. Central banks globally are accumulating gold at the fastest pace since the 1960s as they prepared for the collapse of Bretton Woods. Perhaps the most unsettling aspect is the emergence of central bank digital currencies and alternative reserve systems mirroring France's challenge to dollar dominance in the 1960s. China's digital yuan, the European Union's efforts to reduce dollar reliance, and growing calls for a new international monetary system all echo the concerns raised about American monetary privilege. But here's the truly maddening part. We have 80 years of historical evidence demonstrating that ignoring these warnings leads to catastrophic monetary collapse. Yet our leaders are repeating the exact same mistakes. Federal Reserve officials dismiss concerns about debt sustainability as political rhetoric. Treasury secretaries insist the dollar's dominance is permanent thanks to America's economic strength. Defense officials argue our global military presence is essential for stability, regardless of how it is financed. We are back in 1965 with Janet Yellen playing the role of Henry Fowler, insisting the fundamentals are sound while the mathematical contradictions become impossible to ignore. We are even using the same phrasing, calling dollar dominance an exorbitant privilege, the very term Charles de Gaulle used to describe the system's fundamental unfairness. The greatest irony is that modern American economists have rediscovered many of Rueff's insights into monetary systems and international finance, yet they treat them as novel theoretical developments rather than warnings we have ignored for 8 decades. Academic papers on fiscal dominance and debt sustainability essentially rehash the same mathematical proofs Rueff published in the 1950s. Your retirement accounts, your savings, your children's financial future all rest on a monetary system operating under the same impossible mathematics that destroyed the gold standard. We are funding a global empire through deficit spending, creating money faster than we generate wealth, and dismissing critics as outdated thinkers who don't understand modern realities. Jacques Rief's warning was not just about Bretton Woods, it was about the fundamental impossibility of any monetary system based on endless expansion backed by finite resources. Whether the system promises convertibility to gold or debt sustainability, the math will eventually call the bluff. The countdown that began in 1944 did not end in 1971. It simply reset with a new set of impossible promises. We ignored the warning when we had 20,000 tons of gold. We ignored it when we possessed the world's largest manufacturing economy. Today, we ignore it with $33 trillion in debt and a global economy increasingly questioning our ability to honor our commitments. Jacques Rueff gave America an 80-year head start. We ignored it in 1944. We ignored it in 1971. We are ignoring it today. The math hasn't changed. Only the timeline has shortened. The question isn't if this system will collapse as Bretton Woods did. The question is whether we will finally heed the warning, or if we will spend the next decade ignoring critics until the day we are forced to admit the French economist was right all along. History doesn't repeat itself, but it certainly rhymes. And right now, it rhymes with an 80-year countdown.